Okay, hi everyone. Gonna be the video here for chapter 14, the first half of the deck. What are we looking at here, right? Well, in this chapter, we're really looking at the tax consequences of home ownership, real estate, so on and so forth. So the starting point here, right, is we're going to talk about a dwelling unit, which is basically an area where you can live and sleep, right? Typically what we're going to think of is a house. It could also be a condo, a mobile home, a boat, right? It really has to have sort of that residential component to it insofar that, you live and sleep there. Now, when we talk about dwelling units, right, you can either classify them, right, like here's a place we live and sleep. It can either be like a residence or a rental, right? How do we kind of make that, determination? Is it a residence or rental? Well, we have a little test, right, that tells us on there, right? In other words, it is a residence if the number of personal use days is more than the greater of 14 days or 10% of the rental days in the year. If you meet the test, if yes, right, it's greater than, it's considered a residence. If no, right, it's less than, it's considered a rental. Let's look at a couple examples here. Right, we live in a primary home for 11 months. Oops, sorry, that's going off track there. Primary home for 11 months. And we have a vacation home we live in for 30 days. And there is no rental use. Right, in this case, right, for both the primary home and the vacation home, it's going to be yes, yes, right? In other words, the amount of, in this case, the personal use days, right, 11 months and 30 days, is greater than 14 or 10% of the rental days. So the rental days here is zero. So what's the bigger of 14 or 10% of zero? Zero. The bigger of those is 14. So in each of these, it's greater than on there. If we change the facts, right, and we just focused on the vacation home and we said, oh, okay, we rented that for 330 days, right? In that case, we're going to have no for the vacation home, right? It's less than 330, right? 30 is less than 330, so that is going to be considered a rental in that case, whereas the home, the green guy, will still be considered a residence. So, right, you can see the framework, kind of step 1, step 2, step 3 for how you can map that out. In that formula, right, we talk about, personal use days versus rental days. How do we determine this, right? So a personal use day, typically the best way you can think of it is whenever the person, lives and stays there, right? Hey, I'm living here. I just had a day. I came home from work. I watched TV. I slept there, right? That would generally be a personal use day. You can see there's other kind of variations of that. In distinction, right, a rental use day typically is any day that it's rented out at fair market value or it's being repaired or maintained for rental use. So typically personal use day when you stay in it, rental use day when you rent it for what it's worth. Days kind of where the home is available but not rented are neither personal use days nor rental days. So hey, we have this kind of empty apartment. We're not renting it out. We're not living in it. We wouldn't classify any of those kind of empty days in either bucket on there. One of the things to be aware of is, right, it is possible to have multiple residences, right? We looked and we saw over here, oh, okay, both of these, right, both a vacation home and the normal home would be considered residence. Like, yes, they passed the test. When you have multiple residences, right, you have to have a principal residence And then all other ones are considered secondary residences on there. Well, what's a principal residence? Well, it's kind of determined by the facts and circumstances. It would look at, among other things, where you spend the most time, where you live, where you sleep, how close it is to your work. It's kind of like you know it when you see it type thing. But here's kind of the framework, right? Imagine we had multiple properties like A, B, C, D. For each one of them, right, they're a dwelling unit. We have to determine, is it a residence? Is it a rental? Is it yes or is it no, right? Greater than or less than. Say that we kind of ran the analysis on this, right? And A is our primary residence, B is our secondary residence, and then C and D would be considered rentals, right? That might be like one way how this shakes out. To the extent, right, you send multiple things in residences, one of them you have to pick as your principal or primary residence. Why we care about that, right, is your principal residence is going to kind of get the whole shooting match of benefits, of tax benefits that we'll talk about on there. Your other residences or your secondary residences are still going to get a lot. And then your rentals, right, they're going to get some of the benefits on there. And we'll look at each of these, but it's just if you want to have like a high level summary of what's going on, that's pretty good there to look at. Now, one of the things, right, should you buy or should you rent? This is a personal choice, right? There's definitely, good and bad that comes with a home, right? In some ways, it's good because it's like an investment. Every time you're making a mortgage payment each month, you're getting, equity in that home. However, there's also, bad that comes with it. Homes are expensive. There's property taxes on on those homes. Overall, if you were looking at like a public policy standpoint, right, they want people to buy homes, right? It's part of kind of like a good economy. It's part of the American dream. So theoretically, right, the government is going to provide different tax incentives for you to own a home. And we're going to talk about each of these, but it's going to be things like, hey, you sell that house at a gain, we'll let you exclude that gain up to a certain amount. Hey, you pay mortgage interest on that home that you bought, you could potentially get an itemized deduction for this. Similar for those property taxes you pay on the home. And then, hey, if you're self-employed and you have a home office, we'll give you a deduction for that as well. So let's talk about kind of the first benefit, right? The homeowner's exclusion, right? You sell the house. So anytime you sell something, right, that's going to be a disposition event, right? So we know that it's the amount realized minus the adjusted basis. The amount realized is typically going to be what you sell it for, but if it was a little bit broader, right, it's the fair market value of what you got. And your adjusted basis, right, is typically going to be what you paid for it. But we will see there are some modifications, right? So typically it's your initial basis plus any capital improvements. Like, hey, I bought the house for $100,000 and I put on a $20,000 deck on there, right? So my basis is 120 on there. Typically, right, you're going to buy the home. It's whatever you paid for it is going to be your basis. Other things, right, it's possible to have other kind of initial bases, right? If you inherit it, the general rule is whatever it is worth on the date of the death from the person who died. So, hey, grandma died. Her house on the date of her death is worth $500,000. My basis in that house that I inherited is going to be $500,000. If grandma gave it to us during her life, right, it's going to be a carryover basis. So, hey, even though the house right now is worth $500,000, if grandma paid, $50,000 for this 50 years ago and she gives it to us during her life, our basis is going to be $50,000. Carryover, whatever grandma had is what we have. Likewise, if we convert it from rental to personal, whatever our basis in it in a rental capacity is going to be our basis in it for that personal capacity. Right? One of the things to be aware of here is a home is a capital asset, right? So if you sell it at a gain, just in the same way that you sell stock, another type of capital asset, theoretically you have to pay tax on it, right? So theoretically, we sell it for 500, our adjusted basis is 300, right? We have a $200 gain that we have to pay tax on as a starting point for it. So, it's kind of one of those, it's also a personal use asset. So if we sell it at a gain, we have to pay tax. If we sell it at a loss, we don't get to use any of that loss. It's like your car, your personal use car. So that's the starting point. Like theoretically, you'd have to pay tax on that gain. But to encourage people, right, to kind of start with a starter home and get bigger and have a family, right, kind of we're like the Jeffersons moving on up, getting bigger and bigger. The IRS comes in and says, hey, if and when you do sell that home, right, if you sell it at a gain, we will let you exclude up to a certain amount, right? So if you're single, up to $250,000 of the gain you can exclude. If you're married, $500,000, right? That's the idea with it. So let's look at a simple example here. A taxpayer has a basis of $100,000. They meet the requirements, so we're going to see there's some rules for this. And they sell the home for $400. Right, so they sell it for $400, amount realized, their basis is $100. Hey, they have a $300,000 gain on there. Let's say the person is single, right? Of that amount, $250 is excluded and $50 is included. In other words, taxable. If they were married, right, if they were MFJ, of the 300, right, all 300 is excluded. In other words, it's a higher threshold there, $500,000. So that's the idea, right? If you live in a home and you sell it, you could exclude the gain, but there's rules to it, right? Now the rules are this, right? In order to qualify for that, you have to meet an ownership test and a use test. And it basically says, look, you have to have owned that property for at least 2 of the last 5 years, measured from the date of sale. And likewise, that property must have been your principal residence for 2 of the last 5 years, measured from the date of sale. So in other words, it's got to be this guy right here. We talked about that classification, right? Once we say, oh, okay, it's our principal residence, we look at the date of sale. Okay, we sold it on this date. Go back 5 years, right? Within that window, right, at least 2 of those years, right, did we own it and did we use it as our primary residence? If yes, we can exclude the gain. Most of the time, right, like people are just living in it, the entire time. So we don't have to see any kind of issues here. But it does get a little bit more complicated when, hey, we rented it out some of that time. But one of the things to be aware of here is that the ownership, so it is 2 different tests, own test and use test. When we're talking about the ownership test, it does not need to be continuous, and it does not have to cover the same 2-year period. So for example, assume the same home in the below fact set. Here, both the ownership and use test are met, right? So in other words, we owned it in year 4, year 5 there. On there, we met the ownership test, and in years 1 and 3, we met the residence test, right? So we met the ownership test, we met the usage test. There we go. Well, we can exclude the gain there on that. One of the things, right, so the general rule is if you're married filing jointly, it's up to $500,000 that you can exclude if at least one spouse meets the ownership test and both spouses meet the use test, right? That's going to be the general rule there for it if you're MFJ. We do have two kind of exceptions, right? The first one says if at least one spouse meets the ownership test, but here's kind of the big thing. If you only have one spouse meeting the use test, then they're going to cap it at $250,000. In other words, treat you as single even though you're technically married. On the flip side, right, if you have a widow or widower, right, they're entitled to the full $500,000 exclusion, provided they sell it within 2 years after the date of the death of the decedent, right? So if like Jim passed away, and she sold it within 2 years, assuming she meets the ownership and use test there, she'll get $500,000, i.e. they will treat her as married, even though she's technically single, right? Jim is passed away on there. One of the things with this is, right, you can't just like kind of tee up the system and every single year sell different properties that you happen to live in. In other words, if you claim this exclusion, right, you have to wait 2 years to claim the exclusion again. So let's look at 14, 1 and 2 here. Hey, they sell it for $450. They have a $300,000 basis, right? There's their gain. Hey, that's below $500,000. Let's assume they met the ownership and use test. They can exclude the entire amount. Here's some more facts. Right, we have a husband who owns a house for 2 years, then he marries wife. After marriage, they live in it together for 4 years, then they sell. Husband was the sole owner for 6 years and resided in the home the entire time. Does the gain on the sale allow the exclusion? Well, yes, right? We're talking here about the general rule, right? One of the spouses met the ownership test and both met the use test, right? Husband has met the ownership test and they both met the use test. They can exclude up to $500,000. Say we have the same facts, except husband and wife only lived in the home for 1 year together before selling. So in this case, right, we're going to be looking at this guy right here. One spouse met the ownership test, the husband, but only one met the use test here, right? In other words, husband meets the ownership and use test, wife does not meet the use test. So we have, the facts set there. Therefore, we're going to treat them as single. They get to $250,000, even though they're technically married. And again, this isn't something you're going to hear once and like automatically get. You kind of have to sit on it and think about it, read it, and then look again on there. One of the things to be aware of here, right, is there are some modifications to this amount, right? We know overall, right, it's 250 or 500K if you're single or MFJ. One of the things that can modify this framework is non-qualified use, right? Like you're using it as your primary residence, then you rent it out, then you use it as your primary residence, then you sell it, right? This guy right here would be non-qualified use. And when that happens, right, we have to do some modifications, right? In other words, if we're using the home for something other than our principal residence during that 5-year window, i.e. it's a secondary residence where we rent it out, then our realized gain for the sale eligible for the exclusion is reduced to reflect the non-qualified use. In other words, the other thing to be aware of here, though, is like if we purely rent it out, that's non-qualified use. But if we're not living in it and we're not renting it, that's not non-qualified use. That's what that guy's saying. What do we do here, right? What's the mechanics of this, right? Well, for non-qualified use, right, we're going to calculate the realized gain, right? We sell it for 500. Our basis is 300, right? There's a $200,000 realized gain. Then we take that realized gain times the non-qualified use, the amount of time there that maybe we were renting it out over the amount of time that we own the home, right? That tells us how much of our realized gain is going to be ineligible. In other words, we do not get the exclusion for and is taxable on there, on it. Once we exceed the maximum exclusion, we're still going to have that tax, but let's look at an example here to show this. It's easier to show it with some numbers. All right, we have husband and wife who purchased a home on 1/1/1 for 350 grand. They live in it as their primary residence until 1/1/4. Then they move into home 2. They sell home 1 for 450K on 1/1/6 with a $100,000 gain. How much can they exclude? Right. So in other words, if we look at this fact set here, years 1, 2, and 3, they live in it as primary residence. They move into home 2 in year 4. They sell home 1, right, that yellow guy, on 1/1/6. So basically, hey, we sell it here. We go back 5 years. Did we live in it? Did we meet the use and residence test there for the last 2 of the last 5 years? Well, yes, we met the ownership and use test. All 100 grand we're going to be able to exclude. In other words, we get the all $500,000 amount. This time, right where we like moved out 4 and 5 and in the beginning of year 6, we weren't renting it out or anything like that. So that's not going to be considered non-qualified use. In other words, where the sign is hanging up in our front yard, we're trying to sell it or whatever, that's not non-qualified use. Let's compare it with this, right? This is a good example. Same facts, except on year 6, they move back into home 1 and use it as a principal residence, and then they sell it home 1 on 1/1/6 for 450 gain on here. So one of the things here is, let's assume in this second example that there is non-qualified use, right? If you like look over to the facts here, it would indicate that amount. So there is 1 year of non-qualified use in there. Or say we rented it out during year 4. So what we do here is, hey, 1 of the 5 years was non-qualifying use, 20%. We have a $100,000 realized gain when we run the math on that. 20% of that, or $20,000, we do not get the exclusion for, right? So in other words, of the $100,000 gain, 20,000 is going to be included in income, i.e. we do not get the exclusion for. In the remaining 80,000, right, we would subject and compare with essentially that $500,000 mark. We're not even over it on there. So that's kind of the setup there with non-qualified use. Typically, you think of it with like you're living in it and you're renting it, part of the last 5 years. The second modification here is going to be, unforeseen circumstances on here. So yeah, again, 250 and 500 are the general rules. However, if we have unforeseen circumstances, we can still qualify for the exclusion despite the fact that maybe we did not meet the ownership and use test. Right? So think about these kind of things. You buy a house, and then you get you live in it a year, and then you get a new job halfway across the country. I didn't own and use the house for the last 2 of the 5 years. Do I get no exclusion if I sell it? Well, the IRS says no, that's unforeseen circumstances, right? Something like a change in employment or health issues or financial difficulties. What we do here is we basically let you partially get the exclusion based on how much time you lived in it, right? So maybe you had to sell the house because you got sick or you got a new job, right? So what you do here is with unforeseen circumstances is you calculate the realized gain, then you take the maximum exclusion, like 500,000 if you're MFJ, 250 if you're single, put that over basically the months that you lived in it over the 24 months that you needed, and then that will give you the amount in that case that we will reduce the maximum exclusion on the gain for there. So for example, suppose a single taxpayer owned and used a home as a principal residence for 6 months and they receive a new job offer, right? So we bought it for 6 months and then we have to move because we got a new job. It forces us to sell the home. You may think, oh, we didn't meet the 2-year requirement. We don't get any of the exclusion on there. However, right, this is unforeseen circumstances. Realistically, they probably wouldn't have a gain in the sense that like it's pretty hard to buy a house and sell it and make a profit within a year or two. Mostly just because like the real estate agents take like a 7% commission and you have selling expenses and stuff like that. But it was like maybe during COVID, right? Like homes went up so much, or maybe you did a lot of work on it. In any event, right, what we would do here is we basically say, look, you needed 2 years, right? 24 months. You lived in it, you met the ownership and use test like 6 months, and then you sold it. So what we do is we said, hey, you were single. In a perfect world, you would have got 250 grand. However, right, you only should get 6 out of 24 months on that as the maximum exclusion you can get, right? So let's look at 14.4. We have a taxpayer who buys a house and moves in on 7/1 of year one. They then have to move for a new job, let's just say theoretically 7 months later on there. So let's say they're MFJ, right? And let's theoretically say they sold the house for a $20,000 gain. 7 out of the 24 months, they met the criteria they needed, 29%. So here the max exclusion, right? We don't touch the gain on here, right? We touch the exclusion. So there is a difference on these, is going to be multiplied by 29%. 145 is the max exclusion we can get. Well, we had a $20,000 gain, right? We're going to be able to exclude all of that on here. Compare that with, right, if we sold the house at a gain for 150,000, I don't know how you do this in 7 months, but theoretically, right, in that case, if it was 150, right, 145 we'd get to exclude. The leftover would be a short-term capital gain. We only held it like 7 months there. We didn't meet 1 year. Couple other things just to kind of quickly touch upon. Home mortgage interest, right? You can get this as an itemized deduction on acquisition indebtedness, right? That's any kind of basically debt that you use to buy, build, or improve a home where the home serves as collateral, right? You can get this, the itemized deduction, on your principal residence and one other residence, right? When you kind of have that framework, yes, no, determined by a yearly election on there. Typically, when we talk about this amount, right, the itemized deduction for mortgage interest, we're talking about, hey, we buy a home, every month we make a payment on it, a mortgage amount, and some of that payment goes towards interest on there. That's typically what we talk about, the cumulative effect of that interest. It can also be interest that you get on home equity loans. Like, hey, I own $400,000 out of my house, right? It's worth 500 and I own 400,000 of that I have paid off. I get a loan against that 400,000 on there. I use those proceeds to like build a new bathroom or something. In that case, when the proceeds are used to improve the home, the interest I pay on that home equity loan can be deductible. If I take the money and I go buy a new car or something, or I go on a vacation from the home equity loan, can't use it in there, can't get the deduction. Now, one of the things here, right, is there is a cap on this, right? The amount of like debt that generates the interest that you can take as the itemized deduction. Basically, if it's before the TCJA, you have up to $1 million in debt. If it's after the TCJA, it's $750,000 of debt. One of the things to be aware of, and you can look through this, like refinancing, there are some specific rules on there, as well as mortgage points, which are essentially prepaid interest, are also deductible on there as an itemized deduction. Likewise, right, you do potentially, right, it says once a taxpayer owns a home, they may seek to refinance the loan or take on a home equity loan. If you pay mortgage points in those situations, however, so you have to distinguish when you buy the house up front and you pay a mortgage point versus on the back end, after you own it, you pay a mortgage point for a home equity loan. Different treatment for those on there. Let's just look at a couple examples. Then we're pushing up against the time limit here. I don't like these to be too long. So they're running some numbers here, right? They're showing you, the items here for itemized deductions for mortgage interest. This is the big one. I would look at this one just to kind of get the basics. In this case, right, they buy a home for $900,000. They make a $100,000 down payment. So hey, our remaining interest or balance, right, our remaining loan is $800,000. If we bought this, right, in 2023, right, our balance that we paid interest on was 800,000. However, right, we're only going to be able to go up to 750,000 of that, or 94%, right? So we paid $40,000 of interest, only 94% do we get as an itemized deduction because we're capped at 750. This is after the TCJA was enacted. If it was before, right, that amount here on the bottom, or I'm sorry, the limit right in there is $1 million. So if you run the facts, you look at that. In the second scenario there, you'd get all $39,000. So with that, right, I want you to look at these kind of examples with mortgage interest and stuff like that. So, look through these couple slides, read them, look at the examples. We will pause here because we're about halfway through the deck and this lecture is about a half hour. We'll pick it up in the second video.